The Iron Condor strategy is good for two different scenarios. First, if you think a stock will go crazy in one direction, but you don't know which direction, the Iron Condor strategy makes money from very big moves. Direction doesn't necessarily matter. Now, number two, if you think a stock is not going to do much if it moves around, but it doesn't really rise or fall too much in either direction, then the Iron Condor strategy can also capitalize on this type of movement. Now, Iron Condors are great for either super low volatility or super high volatility. And they are one of my very favorite strategies because specifically when you open up an Iron Condor, you are going to have a very favorable risk to reward ratio. But taking a look at the technology stock space, in general, Iron Condors can really make good, consistent cash flow, and they can specifically return 20, even 50% per month and give you some really huge moves that you can cash in if you are picking the right companies. Now, let's set up an Iron Condor. As you can see right now, my portfolio is positioned for safety. But if you're watching this in the future, an Iron Condor can be used both for volatile environments and safe environments at the same time. Now, I'm going to open up Netflix. I think Netflix is one of the best stocks to do an Iron Condor strategy. Specifically, if I look at the last 1 year return, this stock has been going up a lot, but if I look at the short-term time frame, like 3 months, there is some very good setups for an Iron Condor. Specifically, for example, if you were to open up an Iron Condor on June 12th, you could have waited up until August 12th, right? 2 months, and this stock basically went nowhere. Now, again, if you're watching this in the future, if a stock is going nowhere, an Iron Condor strategy can fit very well for this specific stock. It can also fit very well for very volatile stocks, such as Tesla. So first of all, let's just go over this Netflix example, okay? Netflix, I'm going to go to trade Netflix options. Okay, I'm going to tell you where this strategy is profitable. So we know that Netflix has been kind of bobbling back and forth at the $412 per share. So it's not really going up a lot. It's not really going down a lot. This is a really good setup. So what I'm going to do is I'm going to pick a 30-day option. Again, I do like 30 days out. That makes this position very easy to hold. You don't have to do too much. You just open it, set it, and forget it. Now, check it out. We don't think that the stock is going to go up too much. It's been going sideways. You still want to build in some security. That's why you see me moving up, okay? I'm moving up because to set up this trade right now, it's at $412. I'm going to be setting it up a lot higher. So if I go to 440, you will notice that this right here has a delta of 0.27, right? So this roughly has a 27% chance of happening, and the premium here is very solid, $640, okay? The implied volatility is 32.93. That is pretty high. It's not exorbitantly high to the point where this is very, very dangerous, but it's also not low, because if it's too low, then really there's not that much money to be made, because low volatility is usually low premiums, and we want to have some good premiums to collect, because in this first scenario, right, there's two scenarios. We're going to do a credit Iron Condor, and then I'm going to show you a debit Iron Condor, okay? So this credit Iron Condor, I'm going to start off by selling the 440, okay? I'm going to sell the 440 right now, and then I'm also going to buy an option, okay? So if we were just to sell the 440, that is risky, right? That's a whole lot of unlimited upside. You see the max loss is unlimited. We don't want that, okay? What we want to do is we want to go ahead and buy an option, okay? So 440 we're going to sell. And notice this right here, 640 is expensive. So we're going to sell expensive and buy cheap. So sell expensive, buy cheap. So we're going to be spending $545, but we're collecting 640, and bada bing, bada boom, we've already gotten started on collecting about $118. But that's not it, right? We want to go back, and now we want to sell some put options, okay? We've sold call options. Now we want to sell put options. All right, so we're going to go down, and again, I want to look for around 27 delta. Okay, so that's a little too far down. Let me go to 380 here, 19 delta. Let me go a little bit higher to 385. This is a 22 delta. Now, it is okay to go a bit lower, okay? In fact, the lower delta you go, the safer that this trade becomes, okay? At 22 delta, nothing wrong with that. Now, we can talk about uneven Iron Condors, but, let's finish this example first. I'm going to sell the 385. All right, so I'm going to be selling 385, and then I'm going to go ahead and I'm going to buy the 380. So right now you'll see that I'm going to buy the 380 strike right here. Again, good implied volatility, 36. I'm going to go ahead and buy this. Now you'll see that the full iron condor is made. Okay, look at this. The profit zone, okay, is between 385 and then it's going to be on the high end, 440. So as long as the company stays here, right, as long as the stock bounces back and forth, you're going to actually realize $220 of profit. Okay, you are going to collect this right away. This does enter your account right away. A lot of people ask me, is this money that I've made? Yes, it's money that you've made. However, this position will be open in your portfolio, and the only way to manage this position is by waiting until expiration. So that means that you're going to be waiting 31 days. Now, would I ever close the position early? In most scenarios, I would not close it early unless it goes very into the red zone, okay? That means it would fall below 382, even below 380 here. If it was hovering in this area, yep, you would want to close so you don't realize the full loss, and the same thing on this side. But in general, terminology here, if it were to stay in between, I'm not going to touch it. I'm going to sit put and collect my full premium of $220, even if it's bouncing around really close to the edges here of profitability. As long as it's profitable, I'm not going to worry about closing this position. Okay, so in this position right here, you want the stock to stay the same. Now, let me show you what a debit looks like, okay? So I'm going to get out of this credit iron condor. Again, a credit iron condor, you're going to collect income. You're making money right off the bat, right away, okay? Now we can pick a very volatile stock, all right? So if we look at my portfolio right now, I'm positioned very safe. Now, what I'm going to do is I'm going to go to something like Tesla. Tesla is a really good example of a stock where you may want to be buying iron condors, because the trend for Tesla is very unpredictable. It'll go up a lot and then it'll go down and then up a lot. And this stock does have some really big swings. I mean, if I go to the 1 year chart, this stock is swinging hard, okay? So buying an iron condor or a debit iron condor is going to do very well. In fact, you can see right here, I am having a partial iron condor that I've sold. It's a call credit spread right here. I'm up $600. Now, let me show you what that's going to look like, okay? So we're going to be buying an iron condor. Now, this is going to be a little bit different, okay? It's going to be a debit. When I'm buying an iron condor, I want to bet right at the money, like really, really close. So here's what I'm going to do. All right, it's at 232. I'm going to be buying the closest to the money option here. So 235, I'm going to buy because I think it can go up or it could go down a lot. So I'm going to buy this. All right, now I'm going to sell, right? Very similar, except now I'm buying the more expensive one. I'm going to sell the less expensive one. So instead of paying all this money, I'm going to, subsidize my cost. It's going to be a lot cheaper. So it's going to be a lot cheaper right now. You see, I have a max loss of 225. Now I have a max profit of 275. So many of my students are very successful with this strategy because, although I'm not a fan of buying strategies, you can have a really good return. And it gets a lot better. So if I go to buy put option, okay, so now we're going to also buy a put option. All right, so let's say that I want to buy, let's just say we're a bit more bullish, okay? So we're going to go ahead and do the 235. We're going to go ahead and buy that, and then we're going to go ahead and sell the 230, okay? So you'll see right here that this is an iron condor, but it is a little bit different because it's going to look like a straddle. In fact, to make it look like an iron condor, actually, I would have to not do the 235. I would have to do something like the 230. Not much of a difference. I'm going to do the 230, and then I'm going to go ahead and sell the 225. Now this is going to look like an iron condor, okay? So right here, you'll see that there is an area here where, I can lose money. But then again, I'm gonna change this, by the way. This right here expects a little bit of a move, okay? So if you move a little bit to 240, boom, you're already profitable. Boom, you're already profitable, okay? So the risk reward here doesn't look good, but it is in fact good because it's gonna move one direction or another, and it's very easy for it to move quite a bit down or quite a bit up in such a short amount of time. Now, if you want a true iron condor, okay, you want it to be, a lot more aggressive, you want to put up very little capital here, you could do something like, you can buy something really out of the money, okay? So, this would be a very big swing, 53 volatility here on this option. All right, then you're going to go ahead and sell the 190. You can see here, now you're getting a much more favorable risk to reward ratio on paper, okay, on paper. Not in actuality, because all trades are actually even money, okay? So if you're getting a higher return, in most cases, it's a higher risk. But let me go ahead and let me do 260 here. That's really out of the money, okay? Do the 265. Now you'll see that I've manipulated my risk to reward ratio by a lot, okay? I'm getting a really big profit, small loss, but that doesn't necessarily make this position better, because in this scenario, now the stock really has to move a lot, okay? So it is really a trade-off. Do you need the stock to move up a whole lot, up or down? Or do you need it to move up or down just a little bit to realize a smaller profit, okay? So this is up to you. This is how I would do iron condors.